for normal institutions that we would think of as fund managers, the holding period remains much more likely to be between 3 and 4 years. You might say that's still not long term, but it's certainly not 7 months. You've got active investment. I mean, if you want to send a message to a company, you can do it in 2 ways. You can sell the shares. That's actually pretty effective. If you sell the shares, the share price goes down, and eventually somebody will notice and they'll effect some change. Either the company becomes a takeover target and you get a change of management that way, or maybe other shareholders who aren't sellers will get together, kick the management out and get some better people in. So you've got the active investment in the sense of fund managers who are actively buying and selling stock, but then you've got activist investors, the ones who actually engage, and they, as it happens, will tend to be passive in the sense of being index trackers. So they will own a stake inevitably because they own the index and they own the companies in proportion to their size in the index. So they can't just sell. So you get this very interesting confusion often between sending a message via active investment, selling the shares, and sending a message via activist engagement with the management of the company. Both are effective. You've got some issues with becoming insiders, though, if you go down the engagement route, which may mean that you can't protect your client's interests. You know, you find something out that means you actually ought to head for the exit at 1,000 miles an hour, and you can't because you've been made an insider. There's all sorts of issues as well about skill sets. I mean, shareholders should not be micromanaging the company. They leave the management to it, and they should step in when something goes wrong. Or they like what they see and they invest more money, and so on. And it's expensive. It's expensive to monitor companies and to have meetings with them and so on. And you tend to get a small group doing all the work and everybody else benefiting from it. Free rider issue. Audit. I could talk about auditing for ages, so maybe I should I'll just skip over this, which is a shame. But there's still some really big issues to do with audit committees, whether they're doing a sufficiently good job, particularly in terms of challenge, whether they adopt. Then there's auditors, whether they are sceptical enough, and can you regulate for this? The Financial Reporting Council has just come out with rather a philosophical paper about professional scepticism. I find this very, very amusing because as a journalist, I am professionally sceptical, and nobody's ever had to regulate to make me be like that. And I slightly feel that if you've got to write a 40-page document telling auditors how to be professionally sceptical, they won't understand the answer. So, you know, there's a issue. Obviously, there's an underlying conflict of interest here. Auditors regard the company as their clients, not the investors. And that's the investors' fault, of course. Investors should actually employ the auditors, and it's exactly the same issue with credit rating agencies. But we haven't got time to go there. Barnier's come out with some interesting proposals that have caused a lot of heart attacks in the audit industry. Actually, I'm not a fan of Michel Barnier, but I've been advocating auditor rotation for a very long time. If the same audit company stays with the same company, I think PwC's been doing Barclays for about 100 years or something like that. The average for FTSE 100 companies is it 40 years or something? It's ludicrously long. Obviously, you get a cosy relationship. And when you bring in a fresh set of eyes, that will evoke some challenge. There's lots of stuff that says, oh my goodness, when the new auditors come in, they don't understand the company. There's a terrible period of risk when they won't see things happening. Actually, when you get company collapses, the auditor gets kicked out. A new auditor comes in. Within 3 months, they produce a comprehensive report that tells you chapter and verse about what went wrong. Of course, you have to pay more for that initial due diligence exercise. But it would be a much better service to shareholders than having the same old people auditing the same chums all the time. And we've also got competition issues, obviously, with a Big Four. I should say, I'm sure there's some auditors in the room, and there's going to be an opportunity for questions later when we've both spoken. We've got some other issues as well, which I don't have time to go into, but what it shows you is that corporate governance, which people think is sort of narrow and technical and process-driven, actually covers a real multitude of issues, all of them interesting. Obviously, board composition is interesting to a woman. I hope it's interesting to men as well. There aren't enough women around, and Viviane Reding, who actually I am a bit of a fan of, she did a great job at the telecoms. She's getting pretty impatient with slow progress on this. So personally, I would normally be against quotas, but when you see snail-like progress, you begin to wonder whether something firmer has to be done. Absolute raft of documents from all sorts of authorities on narrative reporting. Don't have time to go into that, but it does bring in some of these subjects which are rather sexy at the moment, ESG factors, environment, social and factors and governance and so on. People, profits, planet. There's lots of buzzwords in this. And we've got board evaluation, which is actually still being developed. External organisations coming in to see how well a board's working. So just the last two slides are on the bigger issues, which I've already started to allude to. The first one is that we are getting to the stage in financial services where regulators and lawmakers are doing the board's work. This is not a satisfactory situation. Boards have brought it on themselves. I mean, whatever made them think that having 2% of equity capital to their risk-weighted assets, never mind their total assets, which tend to be twice as much, whatever made them think that that might be adequate, I don't know. It's sad. So they brought this on themselves, but I wish we could have a disconnect and actually go forward treating boards like grown-ups who've learnt their lessons, instead of saying, we give up on them, the regulator has to micromanage this. The regulator has to say how much capital. The regulator has to say, oh, you seem to be doing rather well this year. You should keep more of that as a reserve, build up your equity for the bad times. Banks are cyclical companies. Does the regulator really have to tell financial services companies this? It ought to be absolutely obvious. They may break the business up, so they may start to prescribe they are starting to prescribe what sort of businesses you can have under the same roof. More sympathy with that. I mean, there are conflicts of interest in having certain businesses together, which it's the easiest way to resolve them is just not to go there, but still. The pay, as I've shown with pay, I mean, this is getting extremely prescriptive. We're almost at the stage where you've got governments setting pay levels in the industry, which would be a terrible outcome. And then you've got consumer protection. I've recently been going through the mortgage market review in the UK, and my heart sank. The regulator is setting out how you work out affordability. Lo and behold, you find out what the client's income is, what their outgoings are, and you build in a little bit of headroom for the fact that interest rates will go up. Again, it's teaching, surely this is teaching grandmothers to suck eggs. And even worse, they don't even allow mortgage banks to do their job, which is to do a proper assessment of the asset backing the mortgage as part of the process. So it's all just to do with affordability, as if it was unsecured lending. I mean, this is what happens when regulators start to run businesses. They don't do it very well. And of course, this will be a further dampener on mortgages. Composition of the board I've mentioned, and so on. Last slide, another set of big issues, and I think I've got a bit more sympathy with this, or at least I think this is. I don't think the former is inevitable. I think this is inevitable to some extent. Financial services companies as vehicles for public policy. Obviously, it happens in China all the time, and they're sitting there saying, well, it's worked for us, and your system didn't seem to work for you. Now, I'm very much not a communist. I'm pretty capitalist. But in financial services is a political sector. I think there's been some naivety in thinking that we've had 20 years of a politics-free zone in financial services, or, alongside light regulation. Actually, it always has been used to deliver policy. This whole subprime crisis was a politically driven event, with politicians wanting to extend the American dream of home ownership and doing all sorts of things that actually literally undermined lending standards. So it's not, it is political, and this is with us to stay. But we're obviously we're going through a period now with governments reasserting themselves of that being even more overt, and it's, just leave you with this. I think it's fascinating the way that Citigroup is advertising itself at the moment, pointing out that it was one of the financiers involved in the Marshall Plan, that it helped build the Panama Canal. This is Citigroup as a funder of public infrastructure and public policy and Marshall Plan. The last great rescue will probably need another one in Europe. So the financial services are vehicles for public policy. And it's in governance terms, the difficult question is to say, well, to what extent can we do this and keep them as normal private sector companies run for shareholders, and to what extent do you have to allow for politics and other factors to have some bearing on a sector that does, as was said earlier, have an impact on all our lives in the real economy? Okay, thanks very much.